Hello, I Tasin Sultana, Assistant Professor, Department of Commerce, Government First Grade College, Presetam. In this session, I will be discussing mutual fund schemes. The learning objective of this chapter is to provide understanding of mutual fund as an investment outlet and personal finance and investment. The session outcome is to make students understand the different schemes of mutual funds. In the previous session, we have done concept and features of mutual fund. Now let us first try to understand what is a mutual fund. A mutual fund is a collective investment vehicle that pools the savings of a number of investors who share a common financial goal. The money collected is then invested in capital market instruments such as shares, debentures, and other securities. The income earned in the form of dividend, interest, or capital appreciation is shared among the unit holders in proportion to the number of units owned by them. Let us understand this concept variable from this chart. See here, investors are the savings from the investors are pooled who have common financial objectives. Then the investors get mutual fund units in proportion to the fund contributed to the pool. Based on their investment fund, they get mutual fund units. The money collected from the investors is invested in shares, debentures, and other securities by the fund manager. The fund manager realizes gains or losses and collect the dividend and interest income. Any capital gain or losses from such investments are passed on to the investor in proportion to the number of units held by them. So the concept is clear. Let us move on to the various schemes of mutual funds. The mutual fund schemes can be broadly classified into four: by structure, by nature, by investment objective, and other schemes. Let us see these one by one. Let us start with by nature. By nature, we have equity fund, debt fund, and balanced fund. Equity funds are those mutual funds which principally invest in stocks. These are also called as stock funds. Mutual funds, these kind of mutual funds generate high returns by investing in stock of companies across all market capitalization. These mutual funds are considered to be the riskiest class of mutual funds, and hence they have the potential to provide high returns than debt. And the studies also say that these mutual funds have at least 65% of their assets in Indian equity markets. So, why in equity fund? Why these funds invest in equity funds is the why the investors invest in these funds. The reason is for long term goal. Then it will give a better return to the investors, and it will also give much needed time to combat the market fluctuations, to cover up the losses which have been incurred due to market fluctuations. The next category is debt fund. Debt fund are funds that invest in fixed income securities like bonds and treasury bills. The objective of these funds is to invest in debt papers issued by government authorities, private companies, banks, and financial institutions. These funds are preferred by those who do not wish to invest in highly volatile equity market. Those who do not want to invest in equity fund will invest in debt fund. There are two types of debt fund: long term debt fund and short term debt fund. In long term debt fund, the maturity period will be more than 1 year. In short term debt fund, the investment will be for 1 year or less than 1 year. The next category under this is balanced fund. The aim of balanced fund is to provide both growth and regular income. You can say it is a combination of equity fund and debt fund. It will take one feature from equity fund, one feature from debt fund. In the rising stock market, the NAV of these schemes may not normally keep pace or fall equally when the market falls. These are ideal, these are suited for investors looking for a combination of income and moderate risk. The next classification is open-ended. Now it is based on structure classification. Are those funds that is available for subscription throughout the year. These do not have any fixed maturity period. Investors can buy and sell at NAV and are those in which investors can enter and exit anytime. Close-ended mutual funds, these funds have a stipulated maturity period, which generally ranges from 3 to 15 years. These funds are open for subscription only during a specified period. Investors can invest in initial public issue or offer, and thereafter they can buy or sell the units of the scheme on stock exchange. Interval funds, these are open for sale or redemption during predetermined interval at NAV. It is, you can say, it is a combination of open-ended and close-ended schemes. The next classification is based on objective. We have growth fund. The aim of these fund is to provide capital appreciation over the medium to long term. These schemes majority investment will be in equities. These are suitable for investors seeking long-term growth over a period of time. Income fund. The aim of income fund is to provide regular and steady income to investors. These schemes invest in fixed income securities such as bonds, corporate debenture, and government securities. The next category is money market fund. So the aim of money market fund is to provide easy liquidity, capital appreciation, and moderate income. This scheme invests in short-term investments such as treasury bill, certificate of deposits, commercial papers. It has capital appreciation feature, it has liquidity feature, and it has moderate income feature. There are other classifications. Under this, we have tax saving schemes. These tax saving schemes offer rebate to investors under specific provision of Indian income tax laws. ELSS is one of the examples. ELSS refers to equity linked tax saving schemes, are funds where the investors get tax benefit of rupees 1 lakh under section 80C of Income Tax Act. The next is industry specific funds. Industry specific fund invest only in industries specified in the offer document. They would have mentioned the specific industry name in the offer document. Only in those industries the investment will be done. Then we have sectoral funds. These schemes exclusively invest in specific sector. This could be industry or a group of industries. Example, pharmaceutical sector, IT sector or banking sector. Exchange traded funds. These are mutual fund units which the investor buy directly from the stock exchange as against the normal practice of buying the units from the AMC or the distributor. These are new in India and cheaper than the other mutual fund schemes. Diversified equity funds are investment in companies regardless of size and sector. It helps in reducing the risk in portfolio. Diversification gives the cushion, it removes the negative impact of the performance. The main aim of the diversification is to protect the portfolio returns from the extreme market conditions. So these are the classification of mutual funds and investors will select whichever is suited for their objective of returns and risk. I hope you have understood these schemes. Thank you very much.